In this edition of VWM University, I'm going to try to remove some of the mystery around a great source of income called Collateralized Loan Obligations, or CLOs. Nothing in this video should be taken as investment advice or a recommendation for any particular investment. It's purely for educational purposes. CLOs are groups or pools of first position business loans that are backed up by collateral or tangible assets. Unfortunately, they're often confused with a similar product called CDOs, or collateralized debt obligations. And those can contain auto loans, credit card debt, subprime mortgages like we saw back in the Great Financial Crisis. Unfortunately, a CDO and a CLO are only one letter different, and so they get confused, but they're completely different things. Big institutions love business loans or private credit because of the fairly high and consistent cash flows. And by packaging 200 or more loans together in the form of a CLO, they get a risk reduction similar to a mutual fund that holds a pool of stocks. If and when the value of private loans goes down because the credit markets tighten up maybe, which they do on occasion, CLOs have a kind of self-healing mechanism that allows them to recover in price very quickly. Although CLOs are very common in the portfolios of big institutions, you don't see them very often in the portfolios of people like you and me, because they're not very well understood and because they can be difficult to access if you don't have millions of dollars. And of course, we've got a solution to that. So now let's work on taking some mystery out of this asset class. I'm going to start with an example that's a little more familiar to most people. Let's say we want to own an apartment building. So we need to come up with $20 million for a 200-unit apartment building, and the rent is $750 a month or $9,000 a year. And I'm just making up these numbers so that the math comes out kind of easy. Also, let's assume that somewhere over the next 10 years, all of those apartment renters are going to have to buy their units for an extra $2,000. So we'll make an extra 2% on each of those units. And we'll have to hire a property manager, obviously, to collect the rent and make sure all of those units are in functioning order. So all that rent comes into the property manager, $1.8 million. We got to pay them a 10% property management fee, so we get a net income of $1.62. Now all we have to do is get some friends together to come up with the $20 million. Unfortunately, we don't have that many friends, so maybe we can scrape together $3 million for a 15% down payment, and then we just got to go convince Wells Fargo or Bank of America to come up with to lend us 85% mortgage, and I'm assuming 5% interest rate. But that would mean we got to pay them $850,000 a year to finance this thing. Terrible. That's really going to knock down our cash flow. But this is the beauty of leverage. We only put 15% down, so that's $770K net cash flow is at 25% cash flow. And then somewhere over the next 10 years, people are going to buy their apartment units and we'll make another 13%. So that's how an apartment building works. Now let's just swap out the apartment building for 200 business loans instead of apartment units. Each one of these is senior secured, large established businesses, and they're all paying 8%. Put a box around this whole thing, and we call that a collateralized loan obligation, which includes the financing. One of the differences, instead of a property manager, we're going to split that function into two. So the trustee will be a big bank, like a U.S. bank is the largest one that is a trustee for CLOs. They're going to collect all of the cash from the loans. And the CLO manager is responsible for replacing loans if they get paid off early, and then also making sure that the CLO meets all of its compliance requirements. There's a long set of regulations to protect investors, make sure there's not too much debt to equity, things like that. CLO manager is responsible for all of that. And they're going to both get paid a fee. But we don't want the CLO manager touching any of the money, because then there would be too much temptation and too much opportunity for fraud, and so we keep those functions separate. Another difference between a CLO and an apartment building is that you're not going to get Bank of America to do an 85% mortgage. Maybe they'll lend 50% of the value of all those loans, and that'll be a pretty safe loan for them. So we'll get a good deal, but then we're going to need to get a second mortgage, and we're going to have to pay a little bit more interest on that one because it's in second position. And then the way CLOs are structured, we're also going to get a third mortgage and a fourth mortgage and a fifth mortgage. That fifth mortgage is going to be probably more of an investment fund or something like that. And they'll be making the highest interest of the five. That's usually a pretty small slice. And then because the financial industry likes to complicate things, we're not going to call them mortgages. In fact, we're not even going to call them loans. We're going to call them tranches. So you have a AAA tranche and a AA tranche and then an A tranche and then a BBB tranche and a BB tranche. And we still have our 15% down payment or equity position, and so we'll call that one, instead of a down payment, we'll call it an equity tranche. And there you have an actual CLO. So all these loans are paying their loan payments to the trustee. The CLO manager is keeping everything functioning. We're getting $1.6 million worth of loan payments. When you add up all these finance costs, it works out to about $820,000 a year. And with the trustee and CLO manager, the CLO manager, again, is making about 0.5%, but then after this CLO is paid 12%, they'll make an incentive fee, so assuming about $180,000 for administration, which gives us a nice even $600,000 cash flow. Let's assume that each year, 10% of these loans pays off early. And since we're buying them for about a 2% discount, again, I'm just assuming some things, but that would give us another $40,000 a year in capital gain. So add that to our $600,000 cash flow. We get an annual total of $640K, and that's an annual return of about 21%. So even though I made up the numbers, in general, that's right around what a CLO might generate, somewhere in that 19, 21, 22% range. And what's nice about this is that because we only put a 15% down payment and we're therefore leveraged, we don't have to take a lot of risk on those loans. The CLO manager doesn't have to stretch for high interest loans. If the bank's making 5% and a company's borrowing money for 8%, that's actually a fairly safe loan. It's really the fact that we only put down 15% that gives us our high cash flow and our high return on this. And this is why big institutions like this so much, because both of its safety and its consistent cash flow. If big institutions like this asset class so much, it seems to make sense that we should take a look at it in our practice as well, and it turns out that we do. We don't invest directly in CLOs, but we do invest in funds that have exposure to different aspects of CLOs. So we use funds that take a look at the equity tranche, the BB tranche or the BB loans, and even the AAA loans. And they all serve different purposes. The equity tranche right now, the fund that we use, has over a 14% yield, and it has about a third of the volatility of stocks. When you look at it over the last, say, 8 years, it's been very close to a total return of the S&P 500. And S&P 500 stocks in general have had a very good 8 years, and this has kept right up with it, but with a third of the volatility. I tend to think that when stocks don't do quite as well, that this will continue its fairly consistent return, so it should blow the doors off of stocks, but that's just me guessing. On the BB loan side, the fund that we use is up over 11%, also fantastic. And it has about a third of the volatility of the equity tranche, so very low volatility. With those kinds of yields, we can look at these for both income and for growth. We just have to be careful on the taxes because the yield is going to be fully taxable. And so we want to pay attention to that. But at 14%, even the after-tax return is pretty good. And then for money that needs to just be safe for a while, the AAA loans is a great vehicle. It's going to be more volatile than a money market, but you're also making more money than a money market. And this should be less sensitive to falling interest rates than a money market. So very low volatility, very safe, and something over a 6% interest rate right now. So you can see that CLO, the various aspects of CLOs can perform multiple purposes or serve multiple purposes in a portfolio. All right, that does it. Hopefully you'll check out some of the other education modules we have, and hopefully this took out some of the mystery around CLOs.